Okay, this is video 1 of the IPCPL. At this point, hopefully people have read the frequently asked questions and read the article. Reviewing briefly, there are many problems with the current state of the art of using publicly traded stock returns. There's unsystematic risk problems. Publicly traded stocks do not price it, but it is priced in privately held companies. Publicly traded stocks are highly liquid, so the returns we're using from those markets are on a very liquid basis. We're applying them to very illiquid investments in control interest in privately held companies that take roughly a year and several hundred, perhaps 100,000 or more in transaction costs, even for, let's say, a $1 million company. We have the small stock premium extrapolation problem. Here we have the small stock premium for publicly traded stocks, and if we extrapolate that curved line, we get a implied small stock premium of roughly 35% for the size of companies we typically value. Obviously that's too much, and that's before converting it to privately held companies. That's on a publicly traded basis, which is what here publicly traded basis is what they're giving you when you get the cost of capital from typical services. The other problem we have is taxes. The publicly traded stocks are based on corporate taxes. Converting them to privately held companies that pay no entity level taxes is very difficult, if not impossible. Another problem is unlevering. Those betas that they give you to unleveraged situations versus leveraged situations. It's all very difficult. In fact, all this becomes so difficult that in a recent Pepperdine survey, 78% of respondents were not comfortable using the current state of the art, which is publicly traded stocks. Now, based on publicly traded stocks. So, Peter Butler and I decided, let's get rid of all these problems. Let's use actual transactions in comparable privately held firms and use the Gordon model to determine what the implied cost of capital is. So that way, we can scratch out the unsystematic risk problem, the liquidity differences, the small stock premium problem, taxes, unlevering beta, and it won't be on a publicly traded basis. It'll be on an apples-to-apples basis. So, let's start with how we did this. And that is, we used 408 comparable companies that were transacted that were over $4 million in revenue. And here is sort of a representation of how that works. We regressed the operating margin of those companies from BizComps and PratStats to the price to revenue ratio. What we were looking for was the normalized price given a normalized margin, which we normalized at 8.7%, being the midpoint between the average and median of the margins for the sample of 408 companies. So we did the regression. It was a curved line, price to revenue, operating margin. It looks like the selected operating margin might be sensitive, but actually as you increase the operating margin assumption, the price to revenue goes up, so that both the earnings and the price goes up. So the price to earnings ratio does not move by that much. But we found a really solid, very reliable set of data around this predicted curve from the regression. The variance here, of course, is things like differences in risk. So we have some companies that are more risky than others, so they'll vary around this estimated curve. So you would expect that. Plus there's noise in the data, obviously. So since all that's expected and we're looking for the average, the estimate of the average is extremely good. So after doing that regression, you're able to make a generalization. So the regression solved for 8.7% operating margin. The model kicked back a 0.505 multiple of revenue. So 7 million was the median for the sample. Remember, the minimum was 4 million, maximum was 30 million. So the median was 7 million, and therefore for a $7 million revenue company, the income, since we did the regression 8.7, is 8.7% of 7 million, which is 609,000. The purchase price is 0.505 times revenue, 3.5 million roughly. Therefore, the price to operating income multiple is 5.8 times. And since 8.7 was the normalized margin, we're able to predict that G is constant at that point in time. Since the growth rate of earnings will equal the growth rate of revenue. So from there, since we have a predictable and market value, we can pull up the model itself and show the regression. And here's where, the previous picture of the regression shows a single linear regression. And what we did is we broke it out to two pieces so that it can solve for the high and the low on the margin. So when you plug it in, it gets a nice R squared of 48%. Low margin, on the low margin side of 8.7%, it predicts a lower price to revenue. And on the high margin side, it predicts a higher price to revenue. The constant in the middle is what you're looking for, which sets the price at an 8.7% margin. And that's 3.921 if it's in logarithmic terms. You can see here the standard error is 0.05, which is really small, very reliable. Converting back to out of logarithmic terms comes out to be 0.505 times revenue. So at this point you have a reliable estimate of what the price would be for a company making a stable margin, and that is where we go forward with determining what the implied cost of capital is in the next video.